and welcome to Fintech Insider Insights. My name is David Brear. I'm the Group CEO here at 11FS. And in today's episode, we're going to be asking, how do you choose the right investment path for your business? Investments have really rocketed in an amazing sense over the last couple of years. But with tough times ahead, it might be time for fintechs to really think strategically about where and who signs the checks, which helps them actually grow. And also, is it more important than just the money that actually matters? So in this show, what we've been doing is trying to put together an amazing panel of guests to discuss, well, how does the investment ecosystem look in a rather odd 2023? How do you choose the right investment for your startup or scale up? And then how do you maintain the relationship after the money is deposited? It ain't just about the cash, is it? We'll discuss all of this and much, much more in today's show. But before that, a few brief messages. Don't go anywhere.
Buying a home is the biggest and most significant purchase most people make in their lifetime. And it doesn't matter where in the world you're buying, the process is rarely easy. In our latest report, experts from our 11FS Ventures team look at why the home buying process is broken, how we can fix it, and the massive commercial opportunity it presents for banks and fintechs. Download your free copy at 11fs.com/homebuying. That's 11fs.com/homebuying.
A lot of you know 11FS for our chart-topping podcasts, our events, videos, reports, and a bunch of other cool stuff that we do. But what a lot of you don't know is that this is just all our side hustle. We do so much more than that. At 11FS Ventures, we're partnering with ambitious businesses around the world to design, build, and launch truly digital financial services. We are building banks, shaping new propositions, and growing existing offerings that change the fabric of financial services. And our design, research, strategy and engineering experts are working to improve your customer's relationship with money. To find out a little bit more, check us out at 11fs.com/ventures. Okay, let's get started. As always, I am joined by an amazing panel of guests who can shed some super duper interesting insights into this topic. First off, it is a Fintech Insider debut for David T. Frank, who is the CEO and founder of Stonehaven, LLC. Welcome to the show, David. How are you doing?
Doing great, David. Thanks for hosting me. And Josh, Ruth, great to be on with you as well.
Very good, very good. For anybody who doesn't know, give us a bit of a background to your role, and for anybody who doesn't know Stonehaven as well, what type of things are you investing in?
So Stonehaven is a fintech capital markets platform, and we've built our architecture to support investment bankers and placement agents who today are representing over 220 companies in the marketplace today, raising capital, doing M&A transactions, conducting secondaries as well. And for the parties operating on our platform, we've built a full operating system that's a combination of technology, data, and infrastructure, and then built the ability for all the affiliates on our platform to collaborate with each other. So we have a 33-person team supporting our affiliates, about half technology and data, the other half running our core infrastructure. Have 100 people today, looking to scale up to about 500 over the next 3 years, and happy to get more into it as we get into this call.
Very, very cool. That growth, it's going well. That's always a good sign in that sense as well. Next up, we have a welcome return to the show. We have Josh Lebacq, who is a director at NA Ventures. That is the National Bank of Canada. Welcome back to the show, Josh. How are you doing?
I'm doing great, David.
Obviously, international audience here. Give them a bit of an overview of you guys in terms of what you do within the bank, but then National Bank of Canada as well.
Yeah, absolutely. I'm a leader within NA Ventures. It's National Bank of Canada's corporate venture capital arm. We invest in and partner with early stage startups to bring innovation, efficiency, and new revenue to the National Bank of Canada. The National Bank of Canada is a large bank in Canada with some operations in the US and overseas.
Very, very cool. Thank you very much for coming back on again. And last but by no means least, we have another welcome return to the show. It is Ruth Foxe-Blader, who is a partner over at Anthemis. Great to have you back on the show, Ruth. How's it going?
Going great. Thank you.
And for anybody who, anybody who's been living under a rock for at least 5 years of everything that's been happening. What's an Anthemis when you guys are doing it?
Yeah, so Anthemis is a multi-stage venture capital investment platform focused on positive change in financial services. So we're sector-focused investors. We have about 200 portfolio companies, and we've been at it for the past little bit more than a decade.
Very cool, very cool. Do you know what? I'm always happy when our producers do a really good show and get 3 people on who know exactly what they're talking about, which is going to be good. It's going to make my job so much easier on that one. But maybe if we get started then and take a look a little bit about the general landscape. I mean, 23 is it's a bit of a funny year, isn't it, when it comes to everything that's happening from a funding perspective. So I guess for organizations that are just getting into fintech, it's a bit of a weird time to be raising, a bit of weird time to be sort of taking things to market. But maybe if we have a little bit of a brief discussion about what are the funding options for organizations. I'm always a big fan of profitability and reinvesting profit. It seems like a good way to go forwards. But Ruth, maybe starting with you, what's the options available to a startup getting into the game in 2023?
So a startup getting into the game, I assume that we're talking about an early stage company, which is perhaps just a couple of folks working on a project, perhaps have done a little bit of experimentation in order to establish some early signals of product market fit, or perhaps they've just developed the product itself and are looking to test how the product is going to be received. That said, there are other ways to do this. Certainly, we're seeing bootstrapped companies coming to market and having quite a bit of success raising venture capital for the first time. But if we focus on early stage founders, I would say that the way that you're going to address the market right now is really no different from how you would have done it, a few years ago. Certainly, capital availability has changed pretty substantially, and there have been a number of distracting events affecting the ecosystem, particularly in the last couple of weeks. So you might not have as speedy responses from investors as, let's say, the height of the hype in 2021. But nonetheless, I would say addressing the market as an early stage company is going to be very, very similar to the way it's always been. Looking for investors who have invested in projects that are similar to yours, perhaps getting introductions to people through others in the ecosystem, which is always a great way to get a first look, and having a fantastic pitch.
Like having a good pitch, it never hurts you, does it? So I guess on that point, I mean, you touched on it, but 2021 was like the all-time high when we were sort of seeing fintech investment. We saw a 46% decline in 2023, and actually the number of really big rounds fell by almost 60%, which is quite an amazing thing to sort of to see. I mean, Ruth, maybe sticking with you on that point, do you think that it is all sort of macroeconomic, environmental issues that we're seeing? We're seeing wars, we're seeing recessions, we're seeing all sorts of crazy. Is it all down to that, or do you think it is almost like the cycle that we're in as well in terms of the size of the organizations and the stages that they're getting at?
I would say it's much more macroeconomic than anything else. There's, for anyone who's building in the financial services space and who is working in the financial services space, we all know that there's still quite a lot that technology has to say to the way that we work and the way that our productivity and certainly, markets that we can be addressing. There's a ton of opportunity. That hasn't changed. What's really changed is the macroeconomic climate. And it kind of feels like, we're going from hurricane to landslide. Unfortunately, we've been dealing with a number of exogenous events which most founders might not encounter one of these in their lifetime, let alone, one every 6 months or, a couple a year. We've had pandemic, war, bank runs, you name it. I had an LP the other day who was saying, we're really trying to figure out which black swans we should be anticipating. I was like, oh, this is my favorite brainstorm, what could happen next? But I do think that it is largely the macroeconomic climate, the tightening of monetary policy, the raising of interest rates, which has had an impact on how much capital has, entered the asset class. And then a lot of, as I said, just events that have happened, which have made investors skittish and which have caused capital allocators and the capital markets to look slightly differently at valuations which means that companies are focused on rather growing into valuations that they raised at previously than addressing the market for an influx of capital.
Yeah, and obviously, I mean, that has had a knock. I mean, Silicon Valley Bank, all different types of things. We could go off on a tangent for a couple of hours on the knock-on effect of those dominoes kind of kicking off. But I mean, Josh, anything to add on that? Because obviously, I mean, it's a weird time for startups in that way, and actually, this change in tact of maybe that traditional, this is the way to go to market, this is the way to find funding to do the things. I mean, it kind of plays into players like yourselves opportunities, really, because people are looking for different ways of doing things. They're not just looking for funding, they're looking for partnerships to help scale their organization and expose them to other people.
Yeah, of course. And there's many different ways to go get that funding depending on what your objectives are and where you're trying to head. In the context of this conversation, we're talking about venture capital and equity, but there's also the debt option, or for certain businesses, they can go get some types of grants as well. And what your objectives are going to seek funding, whether it's to invest in the business, to meet regulatory capital requirements for some types of business, or because you need a balance sheet to provide loans to your customers, all have a different impact on what your fundraising strategy should be.
Yeah, and in that route, the difference between traditional sort of VC route, which we'll come back to in a second, Ruth, but and actually the more sort of a capital investment requirement from a bank. How does that sort of differ in your mind, and the sort of a various attractiveness to different parties?
Yeah, I think when you look at the bank, we have to put emphasis that not all big banks invest in the same way or for the same purpose. The banks or other corporate venture capital groups, in my mind, fit into three broad categories. The first is one that's purely financial. Their primary investment focus are financial returns, and by all means, they act like traditional VC funds. The second is strategic investors. This category still cares about returns, but has a more nuanced view on it than traditional VCs. The focus is often on outsourcing ways to drive innovation and other benefits for their parent corporation. This is the case for us at NA Ventures. We evaluate our impact beyond the financial returns and focus on the positive impacts we can drive to National Bank of Canada as well. This means that we're much more interested in developing a meaningful partnership with our companies. The last category that's worth mentioning are what I'll refer to here as explorers, companies that don't have a formal or well-defined corporate venture capital fund, but are interested in investing either to learn about emerging technology and business model, to take advantage of a new approach to capture upside, or in some cases, simply to entertain some senior executives. Each of these have their trade-offs of what you're going to get out of them, what's the expertise you can bring up the table, and it all comes down to what are you looking for as a company when you seek fundraising.
Yeah. I mean, it's interesting that point on you make around this sort of strategic nature of those things in that way. And actually through other conversations with, I've had with HSBC or Lloyds Banking Group or Wells Fargo or whoever, they sort of invest in that way of almost bringing fresh air into organizations to sort of infect a different way of doing things. And that's an interesting way of thinking about investment in that sense, because the knock-on effect of that, as you say, is much more strategic than it is financial, Is that the case in many organizations? You must mix in, more corporate VC company. Is that typically the way that other organizations are seeing it as well?
It varies on the group, especially within banks. Some really have the financial focus, and they're a division similar to a private equity arm or traditional fund managers. They're just seeking an alternative asset class and exposure. But many of them, including those you mentioned, David, really take a partnership approach. They're trying to expand the bank. They want to work with the startup to generate these new ideas, efficiency, revenue source, and so on. And it's a very different value proposition to the startup founder. they'll be receiving a lot more than a capital injection, probably referral or commercial opportunities, which are very interesting. However, it's important not to put aside that working with the bank does have its challenges. One of our senior executives often says, nothing kills a fintech like a big bank. And it's something to keep in mind. There's a lot of hurdles to go through to partner with the bank. There's things involved. However, if you can do so successfully, you're really opening up your target addressable market and creating value. And it's a very big sign to other large corporates that you can work with them as well.
Yeah. Do you know, I've been on the phone with two bank procurement departments today. I can definitely attest to your senior executive's sort of comment on that one. But David, maybe coming to you on that point. I mean, it feels like this is a pretty tough market for people kind of getting into. It feels like the challenges are quite different in 23 than they have been before. I mean, it feels like quite a different game for players getting into the market.
Absolutely, David. So coming into this year, it really has felt like VC investors are recovering from a hangover that's still being cured right now. There's still a lot of people drinking water and recovering from that hangover. And valuations are obviously down significantly. I mean, that's very clear in the market. Deal volume, I think the year-over-year deal volume doesn't really reflect the true challenging nature of what's going on. Because if you look peak quarter to troughed quarter, deal volume in the fintech space is down about 90%. That was as of Q4. And while lots of capital was deployed into companies, I think a lot of these companies won't survive. So I do think we're facing a situation where about 75% of companies have less than a year of runway at the early stage. So like it or not, I think we're facing a mass extinction event for a lot of the weaker players in the market. And to some degree, that consolidation is really natural, but by no means is that pleasant. And I think a lot of people look at the VC landscape and say, okay, there's record amounts of dry powder in the market, and so that will address it. But I actually don't think that will be quite the case. I think the deployment cycle is going to be much slower right now, much more deliberate, a lot more capital focused on fewer companies, especially existing portfolio companies. And with the IPO window largely shut, SPACs less likely to be acquiring given so many are shutting down and corporate M&A down. I think that the amount of capital being returned to investors right now is going to impact their speed as well. The SVB situation, as much as just about 10 days ago, it seemed like it could have been an existential event. It actually, in the direct impact hasn't been seen or was not there. Obviously, depositors were saved, and it actually even seems like the lending lines are actually still intact. However, I think we just experienced a near-death experience, and after facing something like that, I think just the degree to which allocators are rushing to go deploy capital is not there. And so what we're seeing is a lot of term sheets offered today that include much more restrictive covenants with ratcheting mechanisms, other structural elements that are less attractive to founders. And essentially, dollars today, I think, are less attractive to founders than dollars in a previous part of the cycle. The last thing I'll point out that I think is unique to where we're at right now in this cycle is applicable to a smaller subset of companies, but it is highly applicable, and I think it will become increasingly applicable, which is that companies that raised too much money and deployed it poorly are going to face situations where their preferred equity can be close to the valuation of the company. And of course, the first reaction is that's ridiculous. How could somebody be worth what they've actually raised? And speaking to somebody who's bootstrapped their business and never raised $1, it's not my situation. However, if that is the case, you're sitting in a situation where common equity could be worthless. And if companies need to raise additional capital, they're going to need to restructure their preferred capital stack. And that's quite painful. And I think that's a cycle we're about to head into, particularly for growth stage companies that were raising outsized rounds and pursuing a lot of growth with CACs that really didn't match their LTVs. So anyway, we can dive into that further.
Yeah, there's another hour on that one for sure. I guess that sort of takes us to your point. Is a pound now worth the same as a pound before, or a dollar, or whatever? I guess when we've sort of took a little bit of a look at the market as it stands today and the sort of cycle that fintech's in. I mean, Ruth, is fintech still like the hot sector that people are clambering to find opportunities in? Because, I sort of take a look at this from two angles, which is there's still a chunk of money out there. There's still a bunch of funds that have got money that they do have to do something with, and it's way better invested than it is not invested. But equally, when I look at financial services, there's a lot of slices of financial services that are really needing fixing still, and then the ones that we're looking at are not surface level, transactional things. They are, fundamental fabric pieces. So, do you see any shortage of good ideas? I doubt it, right? But is it just the changing landscape that's making the finding those areas of investment and almost believing it still? Is that what the challenge is?
I think that there is a challenge of excitement amongst investors right now. I think that it can be very challenging to just feel enthusiasm when everything feels grim. But I guess I would go back to a couple of points that David made. I think that what is painful is sometimes necessary, and I don't want to say that, this isn't going to be painful for people who are not going to kind of graduate to the next round of funding. But what we've seen over the past few years is like massive grade inflation and, people getting perhaps multiple at-bats when they shouldn't have. That doesn't mean that venture capital is stupid or that there aren't great ideas or that companies aren't really cool. It's kind of the same story. And, having done this for a while, I can say venture capital has always been a game of exceptions. There are still companies raising rounds that resemble 2020, 2021 fundraising rounds. They are exceptional in this market. They are rare, but they're happening. And, what's happening at the earliest stages is quite different from what's happening at the growth stages where, there are really serious challenges. And the point that David made around, valuation compression and multiple compression and the impact that that's going to have on where valuations sit is real. In some ways, it's kind of like, who cares? Venture capital is a funny asset class where people just don't really tolerate volatility. But maybe this is where the venture industry starts to discover that asset prices rise and fall, and that's just the way it is. And if you're willing to stick with it and you're creative, everybody can still make some money. We would strongly prefer just a down round than some crazy term sheet with a bunch of really, punishing terms for early investors and founders. So I think, there is a perspective that things are very grim and everything is bad. I would say everything is just a little bit more like venture always is, which is to say there's this incredible bifurcation that happens. There are companies that take off and fly. And I guess the final thing I would mention is it might be a difficult time to get jobs in fintech, because I do think that that hiring is being frozen and a lot of companies are laying off. But this is not specific to fintech. It's not specific to startups. We're seeing that very large companies, and we all know them, are doing mass layoffs. And, historically, that's been really good for the startup ecosystem because entrepreneurial people with some experience come into the ecosystem and launch great companies and actually have a little bit of institutional knowledge from their previous roles and kind of take a crack at it. And that's really what we need. I think that we will see a contraction of companies, being founded and companies being funded. But I don't think that is necessarily the death knell for innovation.
Yeah. And bizarrely, maybe going to you on that point, Josh, because actually, we are seeing a lot of, to Ruth's point, we're seeing a lot of almost acquisitions by organizations, which, if I'm honest with you, is accelerating the innovation agenda of, some of the big incumbents, a decade ahead because of, arguably, I was talking to somebody this week and I think HSBC's acquisition of SBB in the UK might save HSBC. Like, I really think it's like with a technology platform with like really, technologically enabled humans as well, it kind of feels like that might be the accelerant that they've been looking for. So in this period of time, as you say, Ruth, there's always winners and losers. There's always, gains and losses in this game. But actually, it might really be a big advantage point for the industry as a whole. What do you think, Josh?
Yeah, absolutely. I think that when there's a huge dichotomy between how public markets are evaluated at private markets, it makes mergers and acquisitions a lot more challenging. If you're in an industry where you're being valued, your market cap is defined by 2 times your net earnings, but you have to acquire a startup at 200 times their net earnings. It's really difficult to make that business case, and you really have to believe in incredible growth. Now that dichotomy isn't as large, it's a lot more manageable to make a business sense about doing that type of acquisition and really leapfrogging your current operations or competitors.
Yeah, it's interesting. I mean, David, this is obviously, we talk about startups and scale-ups, and this is covering a real broad spectrum of businesses, isn't it? In terms of, sitting in your garage with your friend to, you're looking for another 20 million to keep the fuel in the tank to kind of keep going. So, how does it play out at different stages? And actually, I guess in your experience, have you seen different types of capital be much more effective at different levels in the growth trajectory of businesses?
So at the early stage, I think one thing that's being looked at a lot more are safe rounds. And because I think in this environment where valuations are a little bit more challenging to decipher, a safe doesn't require a management team or an investor to actually ultimately come up with a valuation, and they can defer that until they ultimately do a priced round and just agree upon a valuation cap and a discount rate. So I do think that's a good option. I think in today's higher interest rate environment, some of those are going from pure safes to convertibles. Because people actually want there to be some more time value of money embedded into the structure. And as far as structural elements that I think are more challenging, I think that there's investors who are pushing for higher pref multiples as to have kind of guaranteed downside protection in the event of a lower valuation exit. But there's a lot of pushback on those sort of terms right now, and we can get into other more restrictive covenants that are at play.
Yeah. Look, if you want the money bad enough, you're going to have to sign up to whatever terms it's a negotiation, right? And that's almost the thing that we're sort of pointing to is when there are multiple people in the market willing to fund things very straightforward, the terms become a lot less, stringent. But when money becomes tighter and startups need it more, it's like anything. The more you want it, the harder it is to get it in that sense, isn't it? But one thing we sort of pointed out earlier on, and I sort of come back to this really. We made the point, it's like a good pitch isn't a bad idea, right? So, but what sort of makes an attractive pitch, particularly in this period of time? Ruth, you must see literally, I dread to think what your DMs on LinkedIn and Twitter and what your mailbox looks like in terms of like the pitches that come through. But what types of things grab your attention now? How do people create differentiation?
Yeah, so we try to see, a couple thousand companies a year kind of per individual on the investment team. I think that, first of all, we're longer time horizon investors. And so while these market cycles can be challenging to specific types of businesses, and in fintech, I'm thinking of, we're lending and businesses that sort of have thrived in a low interest rate environment, businesses that require, let's say, insurance risk capacity. That's been quite a hard market this year. So, we're looking at, this might be a little bit more challenging for the company to scale given its need for either debt or risk capacity, and how does that work? But we're not really obsessed with or focused on these kind of short-term economic cycles, although obviously the company is going to have to weather the storm for the next term, and we're going to have a realistic fundraising plan. But really what we're looking for is someone who's kind of seeing around corners, looking at the future, typical venture fund, the life is 10 years, give or take a few. And we are really looking for things that anticipate where the market is going. And so using technology to facilitate building really interesting, needed products for large markets. And I think someone who can tell a compelling story about how they're doing that always has my ear, certainly. One thing that I kind of bristle at when we talk about like attractiveness and pitching is the fact that there is a tremendous amount of discrimination in venture capital. So women receive about 2% of venture dollars, female-led teams, and people of color even less. And so one of the things that I'm highly conscious of is making sure that no matter who you are or how you tell the story, if it's a great story, I'm here for it.
Yeah. I mean, it is an interesting challenge, isn't it? Because like you say, I mean, whether it's an interview process or whether it's pitching for funding, there's the output sort of tells the story, doesn't it? In terms of 2% of funding, and we've talked about this a number of times on the show before. It becomes very difficult to figure out a way of overcoming that, other than, I mean, blind interviews are a thing to try and iron out that type of discrimination, isn't it? But and it's a difficult one in that, because often, the talk about the jockey versus the horse, Ruth, which one of those do you sort of look at? Is it more the idea, or is it the team that are there to do it? Because there's almost a self-perpetuating thing in that, isn't there? That if it's the team that are there to do it, and there's inherently that bias within the system currently, you sort of perpetuate that bias, don't you, in that way by, backing the team who have done it before in that way as well. So, I mean, we're definitely not going to solve that in the next 30 seconds, I imagine, but it's a really difficult nut to crack, isn't it?
Sure. I can give you my 30-second. So first of all, I think that you're not going to solve it in venture capital alone, because, the underlying social conditions that sort of promote inequality are much more complex than anything that's happening just in this ecosystem. What I would say is a lot of investors do what they call pattern recognition, and I think if you extract the pattern from the individual sort of frame, you can see a lot. I mean, I think I've had really good luck picking founders who might have been maybe underestimated a little bit, but have a lot of fight in them. And I think that, it's not really hard to invest in underrepresented founders if that's what you're looking for. So yeah, very hard challenge, but I always feel like it's important when we talk about what makes a pitch attractive to highlight that the more fundamental the interest is, so it's the jockey and the horse, the less maybe discriminatory the investing process is going to be.
Yeah. It's maybe coming to you on that, Josh, as well. I mean, it's that sort of the old sort of trope of, you're backing the jockey, backing the horse. I mean, if the horse finishes the line without the jockey, he ain't winning the race, right? But either way, you've got to kind of get that balance. So when you guys are looking at the investments that you guys are making, I mean, where does that swing? Is it 50-50? Is it 60-40? Is it like what type of thing are you looking for? I feel like I'm setting all of you guys up for like much more weird DMs on LinkedIn from people. It's like, I hear you're looking for jockey, and but so I do apologize in advance. But feel free to DM all these people as well. I'm not that upset about it. But Josh, what do you think?
I think it's a great question. It's also stage dependent. When you're raising, a pre-seed, seed stage, you're really pitching the idea in the team. But as things move forward, it's really all about execution. As Ruth mentioned, we all hear hundreds of pitches and invest in less than 1% of the pitches that we get. And if all of those great ideas came true, we would be living in a very, very different world, I can assure that. But the reality is, having a great idea is often the easy part. Successfully delivering it is something else.
100%. Ideas are easy. Execution is difficult, isn't it? On that note, we'll probably take a little bit of a quick break. We'll be back with you very shortly.
Hello and welcome
LFG people
to Fintech Insider,
Blockchain Insider,
11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark.
Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Okay, so we've looked a little bit at the pitch. We've looked about how you might find funding, the different types of funding that are out there. Maybe if we look about what happens after that, because Ruth, I'm sure there's not like a lottery-size comedy check in the post, and then there's the picture in the press release, and then you never talk to each other again, right? The after that funding is actually sent over in the announcement, I mean, what happens next? What type of relationship do you guys typically look for, and how does that sort of manifest itself?
Yeah, so it depends on the stage of the investment. I tend to really start to think about what we need to achieve over the next term in order to successfully raise the next round. And it's sort of horrible because, for most founders, fundraising is a slog, and the last thing that they want to think about is how they're going to bring more capital into the business once they've gotten the life-size lottery check from me. But what we typically do is say, for early stage companies, you're raising capital in order to run a series of experiments. And those experiments are going to allow you to understand how to best invest the capital that you've raised in order to grow the business fastest and most efficiently. So we'll typically identify really what those experiments are. I really kind of favor the scientific method, really saying like, what do we need to prove? How are we looking at it? And then how are we going to know when the experiment is done and what the answer is? At that point, we'll kind of then either pivot to something new or double down. But really what I'm thinking about is, what does success look like to an investor at the next fundraising round so that we can raise sufficient capital from great investors quickly?
It is bizarre that, isn't it? The best time to start thinking about the next funding round is immediately after the one that you've just closed out. And I've heard that from a lot of people in the past as well, because essentially it's the trajectory from here to there, isn't it? What do you need to do to prove what now you've got the capital? But I mean, David, how much do you see investors in that? Because I mean, Ruth's got a huge amount of experience in that process. I mean, how much do you see investors playing that sort of mentor role to startups? I guess it's maybe dependent on the experience of the founders running those startups, doesn't it?
So I can break it down into a couple of different categories where I think typically an investor is adding value to their portfolio companies. So I think the first and the most obvious one is helping their portfolio companies scale. Usually those venture teams have either themselves built businesses of the next scale beyond where that company is growing, or they've helped be a part of investing in and helping other firms go do so. The next thing, though, I think is helping identify potential customers, joint venture partners, other types of strategic relationships in the industry where they can really be accretive to helping unlock value. And that's really accretive. And I think the next kind of point to your point, Ruth, is also helping founders understand where the next round's going to come from, and helping whether it's their own follow-on capital or it's other strategic investors in the marketplace, helping them do so. So I think there's a lot there. That's, I think, focusing on all the ways in which things are going well. I think the other kind of whole nother category is when you're facing challenges. And that's actually more challenging and more interesting to me, is when you're in a difficult market, when you need to pivot, when you need to change something on your management team, when you need to reverse course to go faster on your product development cycle, having somebody you can confide in and really talk through those issues, I think is actually the most important thing that an investor can do. And really having that relationship be really open, where your first call is to your investor, because they're a true sounding board and not just somebody that's going to pull up a KPI dashboard and whip you. So.
Well, it's an interesting thing, and the sort of concept of like dumb money, like the people investing in fintech are way too smart for that now. But actually, to your point, David, like, the organizations that are investing in organizations are doing it in order to help them be successful in that way. I mean, actually, Josh, I mean, it's one of the things that I really like about corporate VCs the honesty of that, in that sense. I always say, I mean, a bet that I can bet on, that I can influence the outcome of, is always a much, a better bet. So, the bets you place on organizations, you can fundamentally make them successful by getting the rest of the organization to essentially use or engage with that thing. So, post-investment from your perspective must really be about the sort of introduction into the organization of the thing where it's applicable, I guess.
Yeah, absolutely. You hit the nail on the head there, David, that if we invest in a company and then sign a meaningful contract, we just generate significant upside for us and the company, which is a great outcome. So post-investment, if we haven't already done so beforehand, it's all about getting the company ready to present the right facts to the right people, getting them to sit down with key decision makers, and finding ways once they have an initial contract to grow it further, and really being that partner on how to navigate our bank. And in many cases, a sounding board on how to navigate other banks, because at the end of the day, there's a lot of similarities. You know it very well, David. Banks are their own beasts. And if you're not from within that ecosystem, having a helpful hat to guide you on how things work is very helpful to our entrepreneurs.
Yeah, lots of Jedi mind trick stuff to get through, but it's an interesting one. I mean, how much do you think that will, and I sort of asked this to all of you, I mean, given the economic times that we're sitting in, given the market that we're seeing, how much do you see that relationship sort of shifting? Do you think it will, I mean, to David's point, Ruth, you're not going to be just sitting there with it's now the 23rd of the month. You said you'd be at this point now. Like, do you see it shifting, as in, are you going to have to offer more help, do you think, Ruth, or less help during this period?
Yeah, we're very hands-on investors, and Anthemis prides itself in having a really substantially developed portfolio success function. So we've always looked to add value and to connect our portfolio companies with our ecosystem and our LPs and stakeholders, which, are mainly comprised of banks and insurance companies. But I would say that, providing emotional support is a huge part of my job, and probably the most important part of my job. If you need me for operational support, you might not make it anyway. So, one of my kids joked with me that my job is like taking people out for lunch. And I would say, if I need to eat some more lunches and in nice restaurants with founders and kind of provide some common sense feedback or ask good questions, that's really what I'm around for.
Yeah. I mean, that helps them and that helps you, doesn't it, in that way as well. And actually, the more conversations you have, I mean, it's amazing how much of this stuff, I mean, we live in such a technologically enabled world. It's amazing how many all of these things just boil down to relationships, isn't it? The better, the stronger a relationship you have with whoever it is who's helping you from a funding perspective, the more honest conversations you're going to have, and the more likely it is that it's going to succeed. And it always sort of boils, you say, Ruth, about common sense. Like, it's amazing how uncommon that is sometimes in the market, isn't it? So maybe coming back to the initial question then. I mean, we talked about, like, how do you choose the right investment path? If there's a fintech listening to this podcast right now, and they're trying to figure out which way to go. Ruth, what would be the advice that you would give them on how to pick a direction? Because it isn't just a left or right. We've got like a spaghetti junction of directions that they could essentially go in right now. What would be your advice?
Yeah, I think my advice is, who do you want to work with? Think about who you want to work with. And really, I think, David's point earlier about capital outflows, there might not be as many options as there were, and there certainly don't seem to be the same number of mega rounds and the people who are coming and saying, oh, we're going to write you this enormous check and leave you alone. And that might be a good thing. I think that this is a market where really entrepreneurs need to think about who their partner is that they want to talk to, late on a Friday night about a really important decision, and where they think that they're going to get clarity of advice and not kind of fear and skittishness and, fear of losing or facing a partnership, which is angry, really working with people that you trust and you think are kind of solid, stand-up people who are going to really listen and ask the right questions, I think is always a great choice.
Very good. Completely agree with all of that. David, what do you think? What's the the advice for somebody looking to make the right choice when it comes to their investment path?
So I think to your point, Ruth, I think we're not in an environment where money is easy to be had. So if we're focusing on this from the perspective of the party raising money, I think the key right now is to get in the market and get out, meaning there's a high opportunity cost to raising capital as a founder, and it takes you away from building your business. And I think if you're going to be overly aggressive in seeking terms, amounts, valuations, structures, et cetera, I think you just need to accept where this market is and get back to building your business. Because the biggest risk you can have is spending way too much time engaging in the market. And ultimately, it adds a lot of value to raise money, but the actual process of raising money takes you away from being a builder. So I think finding that right strategic partner in your market is key. And if you're finding, one of the worst kind of things you can actually find with your existing investors is if you're not engaging with them. Because what that really means is they've given up on you because VC managers are really focusing their time and energy on their portfolio companies they think are going to make it and be successful. So it's not always a win if you find that you're not talking to your VC group at all. It can mean a total failure to understand what's actually going on in the relationship dynamics. So I would always be fostering that relationship, even if it's not always easy.
No news might be bad news in that sense, but yeah. Josh, what do you think? What would be the advice you'd give to a startup trying to do this now?
I think what's important to remember is that not all options are available to you either, and they're not all a right fit. Should you be accessing venture capital? Should you be accessing debt? Or should you find another solution to solve your cash flow issue, such as providing a discount to a customer for upfront payment and other methods which can solve you through a pain point and are important. But tying back into David's point, not all investors are the same. You should also perform your due diligence on them. What are other portfolio companies saying about them? What are their current returns? What are their investors saying about them? Because the reality is they're fundraising too, and where they are at in that cycle will very much influence the type of terms that they're going to encourage you to take. And I think that's important. We think about funds often as a 7 to 10 year fund, but most GP structures need to raise a new fund every 2 or 3 years. So there is a short-term interest to not take that down round and push preferred down on you and stuff like that. So I think those are dynamics that you must understand as well before accepting money from an investor.
Yeah, I completely agree with that. I mean, from my perspective, I'd say it's hey, never wait to start thinking about money until you need it. And I completely subscribe to what Ruth has said. It's about a relationship with people in that way. So pick the people that you really want to work with, because it's a long-term relationship that you're essentially getting into to start the growth of your business. So on that note, I mean, I really think we could talk about each of these topics for several more hours, but we are going to have to wrap up. People do have lives that they have to go live, so we better let them go on with it. So thank you so much for joining me, everybody. Where can people learn a little bit more about you and your companies? David, starting with you.
Sure. So best place to find me is on LinkedIn, and David Frank under Stonehaven. Also, feel free to follow our company page, and also reach out on our website. We have a great contact form that goes right into our pipeline. So our team will follow up with you right away if you are seeking to raise capital, invest, or play any other role with us.
Very good. Josh, where can people learn more?
Joshua Lebacq or National Bank of Canada on LinkedIn.
Very, very cool. And Ruth?
Yeah, you can follow me on Twitter. It's Foxe News, FOXE_news.
You must get some really oddly cross-tweeted tweets if you're Foxe News, wasn't you?
You can also find out more about Anthemis at anthemis.com. And if you are a woman working in the VC ecosystem or a founder, you can go to wvce.tech.
Very, very cool. As for me, I'm predominantly lurking on LinkedIn these days, so you can find me and connect with me there. Thank you very much for listening. If you like what you heard, subscribe to our podcast. Don't forget to leave us a review. It helps other people find the show. As always, if you want to join the conversation, you can find us on social media. Just search for 11FS or Fintech Insider. Or if you want to, email us on podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.